As jobless claims just came in and really hit the sweet spot. GDP a little bit stronger than expected. Let's assess the data with our next guest, Alan Knuckman, Chief Market Strategist at BullseyeOption.com, joining us. Alan, let's begin with the GDP revision, a little bit higher than expected and significantly above prior levels. What was it, 1.4 to 3.0?
Yeah, so that's nice, and it just adds to the momentum. So you can't spell momentum without M-O, and it's just mo.
Talk to me about the jobless number, because this one kind of hits the sweet spot. 231,000 analysts looking for 232. I mean, I feel like that upper thresholds, anything above 250 raises some concerns. If you get below 200, things are too hot. Am I right or not?
Yes, and it's fun that we get to do this, on a regular basis about the weekly jobless claims. I mean, when we were kids, the monthly obviously was the biggest deal, and even the market shakes that off pretty immediately nowadays, and it continues to look forward. The key is, obviously the rate cuts, they're coming, and it's 100%. Nothing's 100%, but it's 100% for September. But there is a 75% chance right now, according to the markets, that we'll get 2 half-point cuts. September and December. So that's interesting. But what I find the most bullish is the fact that if you look out to the end of 2025, that they're having short-term rates down at 3%. So that means that rates are going to have to get cut 2% from where we stand right now.
Okay, so let's talk about this and markets, ultimately, what this means for markets, because clearly you're unenthused by the data here, Alan. So in terms of markets, I mean, if we do get 2 50 basis point rate cuts by the end of 2025, we're talking about 3%. This fuels what you've been talking about for a while, right? In terms of commodities and some of the, the ideas that we're in this super cycle or in the midst of, and we're talking crude, we're talking gold, some of the other products we look at, in theory, that would just provide support for them.
Yeah, you would think so, and that's been kind of the mantra. But we did have, as markets often do, you know this for a fact, they had a fake out move. And that August move was not only a fake out in stocks to flush it out, it's a flush. So it flushed out a lot of commodities as well. It really battered silver. It really battered copper, like your last guest had talked about. But they have made a comeback, which is impressive that we've got silver back to $30, but it's nowhere near the recent highs, and certainly nowhere near the inflation-adjusted highs from years ago. So there's a lot of upside. There's a lot of potential. Potential just means it hasn't been done yet. But there's a lot of potential the way it's set up in both copper and silver with this dollar decline. We didn't break 100, but we did get real close.
Yeah, okay, so dollar decline supportive, right? In theory, rate cuts as well. But I'm kind of wondering, what about the concern that these rate cuts are coming because demand is slowing? I mean, you've got the MO or the MO you were talking about. I mean, we're going to need some MO demand if we're going to hold these prices at upper levels if the economy is slowing. And China hasn't been there. Asia, for the most part, hasn't provided that.
Yes and no. Okay, people were very concerned the rates were high, and they were here for longer. They weren't higher for longer. They were here for longer. It took a longer time for them to come back down. But your guest previously pointed out that obviously you're getting a real return on your money right now. You're beating inflation. The inflation has been tamped down. The dollar's down. The VIX is down. And rates are down. So those are all positives, and stocks are all up. So the game has been played perfectly thus far as getting the market reaction that they wanted and handling the situation. And it looks like it's done. So it looks like rates can come down. That was the plan. And, again, as a trader, follow the plan.
Okay, I'm just going to push back one more time, Alan. I feel like Bostic, I'll lean on this one and lean on Bostic's comments this time. What if things don't slow to the point where the Fed feels comfortable? I mean, they haven't really provided that reassurance yet. They've hinted at such, but there's a big jobs report coming out this next week, and we've got a big PCE report tomorrow. So what happens if we start to see some of those expectations slow? Does the market have a hard time holding these upper levels then?
I don't think so. I think the markets, have handled all this data very, very smoothly. Look at the earnings. We haven't had a real chance to talk about that. And the margin growth So the margins are up here at 5-year highs. Yes, the growth is not increasing as fast as some people thought in the S&P, but earnings growth continues. We're seeing double digits earnings growth, and most important for me is the margins that have maintained. And so that's the key. They've been making more money with less revenue, so that's pretty good business. And that's what the stock market's based on. When you really get down to it, the price earnings ratio at 20 right now is still 10% off that high that we had when the stock market was at the records in 2022.
Okay, I like that lean because, Ken, my point earlier with the commodities, the dollar lower isn't necessarily going to do it. Rate cuts isn't going to continue this market fueling higher and higher indefinitely. So we need something a little bit more tangible, and I guess earnings would be that, and some strong results, which for the most part, I guess we've been getting. I keep looking at Walmart as a reflection thereof, and that's a pretty good indicator that things are all right.
Walmart's America.
That's for sure.
Walmart's America, and they've got to definitely figure it out. What I also want to point out is, out of the Magnificent Seven, they've actually lagged behind the other 490 some stocks in the S&P here in the last couple of months. So it's interesting if you look at Amazon, Google, and Microsoft, they have not even recovered half of their losses. So there's a lot of upside in those three stocks that could really contribute to the markets come storming back when they get a little flame, a little fire underneath them.
Okay, well maybe that's the fuel that we need with this spark here to get things going again back to the upside. Nasdaq's lagging a little bit, but the S&Ps and the Dow are within stone's throw of those all-time highs. So we'll see if they can get over that line there. Alan, appreciate you joining us, sharing part of your Thursday. Take a look at the numbers, talk markets. Alan Knuckman, ladies and gentlemen, Chief Market Strategist at bullseyeoption.com.